years' time if house prices fell by 25%. And the amount of negative equity they have would be about 13 billion euro. So that's 3,000 euro for every man, woman and child in the country, but it's not spread evenly unless the government decides to guarantee house prices. They're not going to do that, are they? But it's not going to be spread across every man, woman and child. It's going to be concentrated in certain households. And of the 250,000 in negative equity, about 100,000 would be what I would call severe negative equity, which is 50,000 euro or more, and about 30,000 would be 100,000 euro or more in negative equity. And this becomes much more than, well, you made a choice, you have to live with it. This becomes something that affects the labour market then, because if you bought a lease and you can't sell because you're in 100 grand in negative equity, but you offered a job in Louth, let's say, you can't move because the bank won't let you sell unless they believe that they can lend you the difference between what you would get from selling the house and the outstanding mortgage. So, the bizarre thing about negative equity is it essentially means you double up. If the bank does decide that you can move, you have to double up your negative equity. Because if you bought for, let's say you bought for 350 with a 320 mortgage in 2006, and the home is all of a sudden it's only worth 200,000 euro next year, but you've got 300,000 left in your mortgage. You essentially have to borrow that 100 grand, and that's why the bank says it's particularly severely affected by the increase in the numbers signing on the live register. You mix the last map we saw on the previous page with the one on the left, and actually what the one on the right actually takes this and says, what if the live register does reach 500,000, as people are saying it will if it increases for the rest of the year? So house prices fall a further 25%, and the live register goes up to 500,000. The map on the right shows you the percentage of households, making a couple of assumptions, obviously, because we don't know exactly, but reasonable assumptions, I can assure you. If you want, you can follow up. Reasonable assumptions. You can say approximately what percentage of households are suffering from unexpected unemployment, and it could be just underemployment because the live register does capture underemployment as well as unemployment, and negative equity. So you can see that it's really the outer parts of Dublin's commuter belt that are the worst affected, and again there's a lot of policy implications for that. I'm probably pushing my, I said 25 minutes, I probably pushed that. I'll just finish up with a couple of broader comments, which if there's not enough in there of interest, maybe some of the later stuff will be of interest and we can get a good conversation started. One last thing is, if you think in terms of yields, the yield in Ireland, well, I've just taken Dublin here, Dublin's pretty representative. The yield in Ireland fell from 7, 8, 9% in the late 1990s down to 3% at the height of the boom. The 3% yield is okay when house prices are going up, and it's probably just about okay if the long-term cost of borrowing is going to be 2.75%. But the long-term cost of borrowing, realistically, is going to be somewhere around 5%. So yields should be getting back to, if we want a healthy property market, should be getting back to about 5.25%, say, at least. If yields are going to go to 5.25%, that says something about the ratio between rents and house prices. Rents are falling. Rents have already fallen by 17%. They're going to probably fall by the same amount again, I would expect, again because of oversupply. So if rents fall by a third, then what you see, this is the trend in rents over the last 10 or so years, and this is if they fell by a third from the peak. Now, what does that say about house prices? House prices have come up an awful lot more over the same period, but it means that if you're going back to 5.25% yield, it means that house prices would have to go back down a fall of about 55 to 60%. I'm not saying the people who say 50-60% are right, but I'm saying is that this graph would suggest that a fall in that region is what may be necessary. Now, you could say, well, Ronan, it's all well and good, fancy graph, great, but people live in houses. They don't just view them as investment, so yields are not necessarily relevant. There's certainly something in that, but how much do we discount? Probably not as much as you'd think, because investors are a significant proportion of day-to-day transactions in the property market, and you couldn't really have, now that the lettings and sales markets are almost fully integrated. Certainly 20 years ago, the lettings market and the sales market were very different types of properties. Now you can rent a house on Shrewsbury Road, or you can buy a house on Shrewsbury Road. You can rent a property of any description in any town in the country. So the rental and sales markets are totally integrated at this point. Not totally integrated, but a lot more integrated than they were 20 years ago. And you can't have investors going, well, I'm only going to pay 300 grand for that. And buyers, owner-occupier buyers, aren't going to go, well, that's all right, I'll pay 500 for it. That's not the way it works. So I think that this has more implications than one might initially think in terms of, oh, well, that's okay, that's the lettings market. Now, I did say I'd wrap up. A quick comparison of the overall recession. This is global data. Trade and output and stock markets are falling worse now, or at least as bad now, in the case of output, as they did in the 1930s. So that shows the size of the issue the world is facing. The one graph that's not there is interest rates. The interest rate response has been sharper and faster and lower in terms of the monetary response, and the fiscal response as well has been totally different. So perhaps we're getting it right this time. Funnily enough, Ireland has, you would never know this in the media, Ireland has pretty much escaped the global recession entirely, which is great because this is exports, January to April, Eurostat figures, and this is exports where they were relative to a year previous. And I know there's often a lot of talk about, wouldn't really bother be Finland, don't they have a great model? They do have a great model, but in terms of their exports are nearly a half lower now than they were a year ago. Fortunately, as it says there, Ireland has almost entirely escaped the global recession. That's fortunate because, unfortunately, we're in the middle of our own. On my website I have a post called "Global Recession is just a coincidence for Ireland," and in many ways it is. But the problems we're going through are all consumption, investment. That's the problems. The government, funny enough, is actually up. These are CSO figures, so they're slightly different. The government is actually up 5% in the year to March. I don't expect that to be the case in a year's time. Now, if you had exports the same size as the investment, again, I had to cut it off at 20% because it's twice as big. If you had exports also pulling that down, I would imagine the annual fall in GDP, I haven't plugged it into a model yet, but I would imagine the annual fall in GDP this year would be closer to 20%. So really, we are fortunate that our exporters have been able to keep up the good work while we've been crumbling domestically. 4 problems in the Irish economy. Financial markets, I actually don't know an awful lot about that. I'd say you guys know an awful lot more. I'm guessing it's going to cost us, given the solution that's just at the moment, it's going to cost us about $1 billion a year for the next generation to sort out. So we have to add that into our budget, which is the second problem. Government will spend $64 billion this year, $45 billion on social welfare, education and health. The tax take this year is going to be $34 billion. They initially expected in 2009 to take in $57 billion when they were doing the projections. So it shows you the size of the hole we have. Realistically, tax receipts without crippling the economy could only go up as high as about 42 to 45 billion. So that means we have to get our spending down from 60 billion, or certainly 57 in current terms, current expenditure, from 57 down to 42. So it's about 15 billion in current expenditure. Labour market, as I mentioned, will we have 500,000? Property market, obviously, spent most of the talk about that. This is the hole that the government has. You know, sometimes I argue on the side. I argue, you know, we need to raise taxes. People go, can we not just cut expenditure? Other times I argue, we also need to cut expenditure. Can we not just increase taxes? It's actually going to involve both. We'll need to do both. And some back of the envelope stuff.